Ladies and gentlemen of the crypto space, we're live on a Friday, September 2nd at 11:40 a.m. September 2nd, we're into September, and I would argue strongly that this will be a big month, particularly because of the significant disinflation that the Ethereum network will experience. And you know how we talk about monetary policy here. It's not trivial. With regard to the price point, there's countless factors that go into how the market will respond, but from an available supply with regard to demand, having an extreme disinflationary event significantly impacts the supply and demand balance, which is one of the strongest components in price action. So obviously, I'm highly encouraged to think that this will be strongly appreciative on the price point. Clearly, if there's absence of demand, it doesn't matter. You can have a significant absence of supply, the disinflation, but if there's an absence of demand, it's considering the overall macro conditions, we won't have that strong appreciative feel on the chart. But the reality is the point of the stream that I want to hit on that all these components are independent, and where the market heads and how we position ourselves in the market is really a subjective interpretation of all these independent pieces of information that we process. And a great word is confluence. So we take all of these pieces of information and we hope to build what we feel is confluence that gives us confidence in doing one thing versus another. We look for confluence to suggest we buy, that we sell, what we buy, what we sell, how much of something do we buy, and how much of something do we sell. And generally speaking, the more confluence we find, the more confidence we should have in decisions that we make, and that helps put our mind at ease, and we're more comfortable engaging with the portfolio, more comfortable understanding where the hell we are in macroeconomic conditions, and that's really the only way to have sustainability. You have to be comfortable managing the portfolio. So fear and macro conditions. Pop it over to the main screen. This is a nice chart that someone put together responding to Arthur Hayes' posts. Obviously, in the back, it's drawn, it's the calculations drawn in the background against the S&P. So we clearly see when there's excess liquidity in the system, the equity indexes follow. So obviously we've had a fair amount of liquidity drainage. You can see that in the background. Um, so prices are a little bit below available liquidity, but and look, when prices are below available liquidity, when we hit 364 in the S&P, we had a run up to resistance. So there's also obviously technical trend lines drawn here as well. This is a very nice chart. It's actually quite useful. Is the yellow projections? No, that's July. So that's current, August 31st. So this is the price point that's current, but the data that contribute to the liquidity calculation goes on the weekly. So that's where I think it is. It's a little lagging in that regard. Yeah, August 15th, a week or two. So it's dependent on, obviously the Fed balance sheet primarily, minus the Treasury General Account, the TGA, and reverse repos. So there's so many things that are interesting from a macro perspective that could play out. If foreign nations dump their bonds, the U.S. can encourage commercial banks to buy bonds by dissuading them from engaging with the reverse repo operation, by shifting the interest rate around, or just discontinuing it, which could force the banks to purchase the bonds and compensate for the liquidation of bonds held in sovereign reserves worldwide. And by doing so, the reverse repo facility drops down significantly, liquidity enters the system, and we would see that to the tune of $2 trillion they have in piggy bank form, there'd be a significant increase in liquidity as per what Arthur observed is the relationship between these financial components. Reverse repo down, there's less of a decrease in the Fed balance sheet, or that because this is the new this is the primary component is how much is in the Fed balance sheet. Um, this is a very interesting chart. So this basically is relatively stable. We don't have a significant decrease in liquidity in the system. June, it's been relatively stable maybe since May. Um, and we see that in the price points of all the risk assets we look at. We don't see things collapsing. We don't have any potential liquidity events in the crypto space. I don't think many participants have built up significant leverage. I mean, probably a little bit more since UST's event. Um, but I don't think it's obviously the amount of leverage that typically builds up at the height of a bull market. So there's always risk in the system, but things have been relatively stable to such a degree that we've seen significant appreciation. Um, Curve chart is quite satisfying to look at. Inverse head and shoulders, higher lows significantly, even on the long-term time frame as compared to December 2000, November 2000. And to top it all off, this is a very traditional chart pattern for bottoming, and that's very comforting to see. What we want to see is a higher high. We see a buck 50, buck 60. That's going to be very reassuring of where we are in the market. Looking at the source of truth, I would argue, for the crypto space because of how much liquidity is out there and how much currency is created on a daily basis. The amount of currency that's created on a daily basis for this net deflationary currency, which is that's quite extraordinary. Um, so, I'm going to head to your questions as always, but fear. You know, fear plays a role. Um, Fear is a manifestation of macro conditions and all this data we see. And it plays a role in portfolio management only to the extent, really, I would say, how much cash you have on the books. And what happens is in a fearful environment, an environment of uncertainty, you want optionality, you want a capacity to make choices. So I guess a good part of what I was thinking making the stream was how do you manage the portfolio in this type of environment? And one of the key points I talked about was each of these things are independent. Sure, you can have fear. Sure, you have the data of the macroeconomic conditions. You have the confluence suggesting everything is shit, but you're still managing the portfolio the way you've always managed the portfolio. So, what is the relationship between fear and how you adjust managing the portfolio in this kind of environment? Is optionality. Is choice. You can't do anything unless you have cash. You can't buy real world goods and services unless you have cash. So in this environment, you have to make tough choices and probably carry an overweight position in cash because then you could buy things if there's a significant decrease in an asset's price and you got an opportunity to get a discount, or if everything decreases in value and the portfolio decreases in value and the productivity of the portfolio decreases in your weekly revenue, you have cash to live and do things. So it is a defensive posture. So you want to have that kind of mentality in a market like this, and you want to be overweight cash. So that led me to sell two particular positions that I really like and I think they're meaningful. Um, but I liquidated them, not because I really wanted to, but because the fear has encouraged me to have an excess of cash just in case things go down. And if things go up, that's why the vast majority of the portfolio is exposed to the market. So you have exposure to the market, and the best way to hedge exposure to the market is to actually have cash not in the market. People like to think how do you hedge? You have a long position and a short position to hedge, or you dealing with weighting your option strategies. And sure, that's hedging, but that's more of active hedging. But the simplest way to hedge is cash. You either have a position or you don't have a position. And how do you hedge properly? Portfolio position size and the overall balance of the portfolio. And always remember in the back of your mind the whole point of sizing these positions appropriately and how you balance the portfolio overall is survival. Because if you survive to a cycle of increased liquidity in the market, you buy anything and it's going up in value. So all you have to do is survive to a bull market, and then literally it's anything. It's a free for all. And that's what happens in the equities market. That's what happens in the crypto space, but 10 times as volatile to the upside. You buy dog coins and you can make multiples. That's another story, capital gains and how to make multiples during a bull market. But the point is, this is all about surviving, because then it's a completely different calculation during a bull market. And what's most interesting is, for folks that have been with me in the stream and Discord of late, we've engaged with markets in different ways over the last couple of years. Bet your bottom dollar we're going to engage with the bull market very differently in the coming years. We're going to be much smarter, much more rational, much more calculated. And I'm going to encourage much more passive. Um, but it's the same rules apply. 1% of the portfolio to 10% of the portfolio changes everything. So you need to have optionality. You need to have cash. You need to have those 1% clips that you could throw around to get those multiples. So some things change, some things don't change. But we're going to be able to put these strategies and historic experiences into words and have these topics and and organize the flow of conversation on Discord, so that we're more structured and more coordinated in how we engage, to always maintain maximum rationality, to make the better decisions based on our past experiences. And what does that all mean? That all means folks that are in Discord are certainly making better decisions in this bearish market. We're definitely going to make better decisions in the bullish market, because we've been through these types of markets. Therefore, we have experience. Um, it's a slow-moving indicator, the liquidity indicator. So while it's interesting and Arthur is spot on about its significance, it's not overwhelmingly relevant to today. It's relevant over time, and clearly, if you see a giant spike up to here, you're going to see risk assets respond. So, intraday, it's not that significant. Intraday, you can have all the volatility that we're typically used to. What you want to see is the trend over time, but you come back in a month. This is the type of chart, the bars in the background, that you have to say, come back in a month and you see where things are heading. Um, so it's meaningful, but it's not meaningful on a micro scale. Obviously, more of a macro scale. Love this chart. It's good to see. It's good to see it above this congestion of bars that I've drawn over the years, various time frames, various points, the levels of resistance and support. And right now it's above the meaningful ones. Like this third green bar from the bottom was our Bitcoin liquidation cascade in May of 21. If you folks remember that bad boy, this was a heck of a liquidation cascade in the markets. And there was the bottom wick, and there was three more, and we're above that. So, next levels, I don't know why I don't have levels here. We should probably have levels at about $1.25. But if we really get to the $1.30s, it's only local levels that are relevant. If you get to the $1.30s, we're past the levels of summer 21, last summer. And we're into more of, all right, what's it going to do relative to more recent history, relative to a year or two ago? Very different times, 21 and 20. This chart presents a very interesting history in chart form. And we've talked about that, the hyperinflationary decay, DeFi summer, Bitcoin liquidation, resumption of some kind through 2021, end of 2021, and obviously everything in 2022 has been macroeconomic conditions written all over it. Everything up until the end of 2021 was just liquidity overflow. And you see that here? Yeah, so liquidity peaked out in there, look, December of 21. And then it started to come down in January, and then March was a lower high. So you have the same liquidity in July, in April of 22 as he did in April of 21, except there was a little bit of these peaks up here in November of 21. So that's where it topped out. So it's very interesting to see how liquidity is drained from the system. I wish I could scale this a little bit better. I think I might have to draw it on my own charts. I'll get around to that. Very interesting. Let's answer some questions, help you guys out. Maybe we'll look at some other charts. I mean, convex is bumping from the bottom. I still have my general sentiment about that. At least it's a double bottom, or at least it's a higher low. And we got two double bottoms. I'm probably still going to do the same thing I said I'm going to do, probably liquidate convex when it unlocks on April 19th. I mean, clearly, if it rips to like 20 bucks a pop and VLCVX is printing 20, 30 cents per, fine. I'll have to re-entertain this, conversation with myself. Do I liquidate or do I not? But under current conditions, there's still a variety of reasons to suspect we have macroeconomic mayhem. And that's where you want overweight cash, and I would still have plenty of assets in the market. The hardest thing to do with a portfolio is to either not have or sell something explicitly that you want, that you currently have, or you think is a game changer. So that might actually be a good exercise for folks to do. Have a position that you love. Maybe you have 5, 10 positions in the portfolio, but have something you like, I really love, and maybe it's something that you think is going to change everything. But try sell it and not buy it. Don't have it. Maybe that's a good exercise. Maybe, because that is an extremely difficult thing to do. I mean, why would I not want a balancer exposure after everything we've talked about, how it's a federation? I do have a VL Aura exposure, but I liquidated my Aura BAL position. I don't need the exposure in this market. It's not the same federation as Curve. Do I think it's going to continue to outperform? Have we seen what it's doing? Of course we have. But I don't have exposure, and that's okay. And that was by choice. It printed a higher high, a little bit above the wick back from August 13th. And that's okay. It's okay to miss out on gains. It's okay to not be exposed to the market. You know what's not okay? It's not okay to retain a position that has an invalidated narrative. It's not okay to irrationally hold the position just because it's great technology, because great technology isn't necessarily a great investment. But obviously, those 2 points are not the case for this. This is a case of just needed more cash, and I don't want overexposure to the market. So very interesting what's going on with S&P and equity indexes. Literally S&P putting in this relatively large wick back above the TWAP on the weekly with 5 hours left for the close. If this thing closes above the TWAP on the weekly, that's going to drive bears nuts. That's crazy. And look what's going on with bonds. Bonds pulled back. So it hit 2018, October 2018 yield highs on the 10-year bond as resistance. So that means bonds are appreciating in value as the yields come down. So it's fascinating here as bonds are going up today, and so is equity indexes. How the hell are bonds and equity indexes rallying together? What the actual F? So these are the fun questions that the big macroeconomists are trying to understand. What's really going on is a change, something significant potentially is in the cards for how systems and capital flows are occurring. I mean, come on, does this not look like some sort of structural change? And that's why these trend lines are drawn like they are. Obviously, it's in a long chart, but you can see the peaks, and there's a trend line there. 1, 2, 3, 4 hits on the trend line, and now we're above it for the first time in 41 years. And now we're potentially encroaching on the yield high of end of 2018. And look at this trend line from from December 13th to end of 2018 to a wick above it in June of this year. But if we see a breach of that trend line, oh man, that would be the first structurally and technically bearish market for bonds in 41 years. That would certainly be structurally bearish if we have a close on, I would say, the weekly above end of 2018 highs, above this green line. That would be quite fascinating from a structural perspective. But we get above that white line, we get to like 3.5%. And this chart is in extraordinary territory with regard to a change in directionality, a structural change to how price action is occurring, which is obviously a manifestation of how capital flows are going around the world. Let's look at the dollar real quick, and then I'll hit your comments. Look at that damn rally in the S&P. Jesus, wild. So rising wedge intact. Clearly, just the beginning of the month on the monthly. So we got 28 days, but it's a wick above rising wedge resistance. Let's go over to the weekly. Same on the weekly. It's a heck of a shooting star. You know, we were hopeful for a double top, a tweezer top. Maybe this tops out as resistance. Maybe sovereigns around the world start liquidating their reserves and they sell their bonds. Buy they sell their bonds for dollars. They sell their dollars for their respective sovereign currency. That'll put downward pressure on the dollar and upward pressure on their respective currency, which would send this chart down. I don't know what Europe's doing. Who knows what Japan's going to do? But if Japan keeps printing to peg the damn yields on their bond market, they're just going to keep destroying their currency, which will keep driving this chart upward. But they're going to kill their currency. The chart for the yen is much more exacerbated than just the DXY because obviously there's a euro component and other smaller components of other currencies. That's the deal. Tapsy's in the house. Dan's in the house. Do the issues that balancers seem to have make you concerned at all for their development with Aura? Feels like Aura may be a safer bet. So here's the deal. I want a VE bow position, but it's not there. It's not what curve is. But then again, we bought curve before we knew what curve was. So it depends on risk tolerance and speculation. So often people will be successful with their portfolios and they took a lot of risk to get to where they are. I myself say that is the case. I was in Curve before the Curve Federation was the story that we tell today. But now we have a point of reference to digest the potentiality for these new protocols or other protocols. Balancer's not that new. But VE BOW is not really where it needs to be. The volume on the protocol is meaningful. Um, but Uniswap really dominates with regard to volume. But Curve's next on the list, 1.2 billion. If we get out Uniswap, you're talking about 1 inch, and 1 inch just aggregates everything, so that's cool. So that's going through Curve, that's going through Balancer, it's going through everything. Dodo, I don't know what the fuck a Dodo is. It's probably on Binance Smart Chain, so who really cares? So that's Curve, 0x Synthetics, Cow, and there's Balancer at 47 mil. So Balancers, it's there, it's 5%, Curve 12%. But that's really it's convoluted because of what 1 inch is. 1 inch is an aggregator, but 1 inch is cleaning up. People seem to be going to it, which basically means Curve's going to get the liquidity, or whatever pairs on the other AMMs have the most efficient and best prices are going to route through 1 inch. So that goes. Now we're in tech territory. So and how low the slippage is and the best trade possible will be surfaced to 1 inch users. So that's actually good to see that. Where's 0x? 0x. So 0x and Matka. So if Matka is aggregating from other AMMs as well, these are nice aggregators. Where's Paraswap? I wish Paraswap had a little more attention, but that's unfortunate. Paraswap, small. I happen to favor Paraswap, but they all do the same thing. So that 1 inch I go to sometimes as well. Asun, good morning. Jack, fave NFT. Oh, well, my fave NFT is probably the Tox. I like the Tox. And I also like fast food punks. Those are my favorite NFTs. But that's nothing to do with money. That's just because I bought something and I like it. Food for thought. Food for thought. Zoidberg's in the house. Pepe, hello, master. Which percent of your portfolio is allocated to crypto equities, liquidity? I mean, crypto is historically maybe 30, 40% of the portfolio, but now crypto is like 80% of the portfolio. Equities are about 25% of the portfolio. Cash is a lot, actually. Cash is probably the other 25% of the portfolio. So let's say 75% crypto, 25% equities, 25% cash from a very high level. Um, I guess maybe that's a point of reference. I don't know if that helps much. Dan, was ever an instance where you took a position based on team founders? Yeah, I mean, isn't that exactly what we did with Abracadabra? uh, well, that's a spec play, and that's exactly what happened with Abracadabra. I was engaging with markets very different back then, but that's why I took that position. Um, watch the percentage, watch the position size, and that's your spec play. It's not the core of the portfolio, 1%, 2%, 3% type stuff. And look, we've taken big risks. I took a big risk with Solidly and got absolutely hammered. And now all of a sudden, Solid's going up in price, which is nice to see. They're going over to mainnet. I look what you see what I got up. Ooh, I'm gonna throw everything over there. That's cool. Maybe that bag will reinflate a little bit. That was a very big loss. So there, that was partially on the founder, and now obviously we know that that was not the founder to bet on. So we got Andre. So be careful. The best optimally what we do is we take cash and we're able to buy cash flow at a discounted price. If I could take 100 grand and buy 25% return on the money, 50% return on the money, I mean that's a lot. But if I could buy $25,000 a year, that's wonderful. That's what you want to buy. Ultimately, you want to buy income. And that's the equation for an optimally sustainable passive portfolio. And that's really what business owners do. You're buying a business, you're buying its cash flow, except it's a different percentage, and there's different risk, and there's different liquidity, and there's a different capacity to manage a portfolio of physical real world enterprise as compared to digital enterprise, which is why the digital asset ecosystem, as Dan Tapiero talks about, is so extraordinary. And that's not stocks, that's not REITs, those aren't digital assets. It's representative of real world assets, and it's a whole different calculation that's really annoying as compared to digital assets because there's cash flow. It's an enterprise. You're buying cash flow. Just get it at a discount, and it really is quite unique as compared to anything we've historically had. In my opinion, the best way to curb fear is just stop checking charts. If you have positions and are unwilling to sell, yeah, so carve out your cash. Do you have enough cash? Do you have enough cash to pay bills? Do you have enough cash to do this, to do that, to buy a position if you want to? You need optionality, you need choices. Now, it's really hard to get over the emotion. Yesterday was a very emotional day for me. I was having a lot of anxiety, excitement, and just generally emotions. Like I wanted to, I felt like I didn't have enough cash flow, and in the end, I didn't do anything. And today, I feel better. I'm very content with the structure of the portfolio, and I'm happy that I have the quantity of cash that I do. I'm happy I didn't buy anything, and it's just sometimes we get into these situations where it's like I need to do something, and it passed. This was me yesterday, and today it passed, and I'm like, oh, thank God I did nothing. When in doubt, do nothing, and that's not easy to do. The big twat's in the house. A pleasure. Daniel Lynn's in the house. First time, not the last time. Don, is there anything Congress can do? Seems like all the responsibility is put on the Fed and Powell. Well, Congress is fiscal. Um, I mean, it's all related. It's a complicated, dynamic system of interacting components. Well, it's not for them to do anything. Their responsibility is kind of convoluted between fighting inflation and I mean, in the end, it's all about maintaining a civil society, control, prevent lawlessness, maintain order. That's a lot of the unspoken mandate of really what government's all about: control and order, prevent chaos. So they're fighting a double-edged sword because inflation makes people angry. But if they fight inflation and they destroy risk assets and put the economy into a hole, that makes people angry also. So it's somewhat of a lose-lose situation for government. What would you do with fresh cash from VLCDX? Probably nothing. Man, you just got paid. Take the fair amount to dinner. Pop it on a Juno debit card and, go out to dinner. That's how you do it. That's how I would encourage everyone, at least if you have not spent income, clearly you have to, I encourage QuickBooks. QuickBooks is very useful. And I'm never, ever, ever using one of these stupid DeFi calculators. I'm never using token tag. Not using any of them. I'm managing the books manually. QuickBooks, that's it. Manage your trades, manage your income. So there's trade capital gains, and then there's income. But when you take income, spend it on things, just like you got a salary, because that's what it is. You got a salary. Rupert's in the house, a pleasure. Vet, so hey Noah, what's your thoughts about CRV USD coming within a month? Well, and with the amount of curve the team holds, could it be the most liquid stablecoin DeFi has ever seen? Yes. Can it be a massive bullish catalyst? Yes. Uh, am I FOMOing? No, because I already have a massive position. It's over 50% of the portfolio. Um, what do I think about the amount of curve that the team has? Where do you think all these bribes come from? Where do you think they have this capital? So obviously they're getting income on a weekly basis, and it's millions of dollars, but they're shelling out almost $750,000 a week in bribes. So they have a lot of capital they're working with for capex purposes from an enterprise standpoint. I'm just saying, that's cool. It's 464,000 plus 223, 456. It's about $700,000 worth of bribes on a weekly basis. That's pretty incredible. Concerns regarding SNX and the latest information about atomic swap and Neo mainly being token emissions? So there's three things I think. One, all roads lead to GMX on Arbitrum. All roads lead to synthetics on Optimism. All roads lead to Curve on Ethereum mainnet. And that is the highest level I go. Now, the problem is synthetics is lagging. They got some tweaking to do. I no longer have my synthetics position. I don't have a GMX position. I probably regret the GMX not having that, but I'm not going to get it because I can't get it at the price point that I want. For 20, it's like 20 something percent returns for, you know, GMX, ESGMX type stuff. So I can't get the returns I want. I would need a much larger portfolio. So it's not something I can attain. I cannot have the position size I want, so I don't entertain the position at all. And that's okay to not have a position you want, to respect the portfolio. That's the bottom line. So I obviously have a very high opinion of what's going to likely play out with regard to Curve, and obviously my future depends on it. So that's why I say that. Hello, any concern? Well, I handled that Gazika, so I do have concerns regarding SNX, but I also know the statement is true. All roads lead to synthetics on Optimism. So how do you make that choice? I don't know. It's all subjective. There's plenty. I mean, there's plenty of people with large uh, uh, synthetics positions. I mean, even Tetranode has a synthetics position. It's relatively small for his portfolio size, but still, just is what it is. Did you look at the DXY today? We're still losing hard on the side of of this side of the ocean. You know, pounds and euros. Well, it's 109, but it pulled back from trend, so that's a relatively large wick to the upside. Um, but it's still at 109. Come on, a pullback to 109. That's where we're at. Today's a pullback to 109. So this is exactly why I'm saying the fear is justified in this market. We're having a down day in the dollar and a bullish day in bonds, which is fascinating, a bullish day in equity markets. But if this thing rips to 110 and breaks this trend line to the upside, 110, 111, holy crap, it's gonna, everyone's fear is going to be palpable. You're going to be like, you're going to smell it in the air. So that's why there's nothing to do. I sold the positions I sold. I have the portfolio structured the way it's structured, and I have to be content with it. Huh. Did you look at the DXY? My man, Dan, I mean, if you liquidated VLCVX. So VLCVX, cash, 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 cash. I'm interested in pseudo when it gets liquidity. So I never went down the rabbit hole with XBON. I'm interested in seeing how that plays out with regard to volume on the protocol and if there's a cash flow transfer, if it's productive. So look, I resisted engaging with that to respect the way I engage with markets. The most important thing is to follow your rules, to respect your portfolio, and that sometimes means not making money, and that's okay because in the end, in a couple of years, if you have a friend or a colleague that makes 10 times more money than you, but you're still very successful, you followed your rules. The second you fuck up is when you start to try and achieve what other people are achieving. You step outside of your comfort zone, step outside of your box too far is when you're likely to make mistakes. You always have to do what makes you comfortable because then and only then can you effectively manage the portfolio and let it sit overnight for a month, for a year. You can't let it sit unless it's your rules. Just remember that one. Mapping everything into Doge chain these days. APR has been 200% for Ethereum USDC. My friend, good luck. I have, you can make money, and that's okay. No interest in really contemplating whatever's going on over there. What price point would you look at for GMX entry? I have no idea. I don't, you know what? Here's the thing. It's not even price point. I don't have enough capital. I cannot have a position size I want. So I can't entertain it. You know, it'd be nice. It'd be nice if convex like goes 5x or 10x on the money, and then maybe I could trim and have some additional capital. I don't know. I have no idea. But as of right now, I couldn't even at a discount, a significant discount. I couldn't attain the position size I want, so I don't entertain the position. Liquidity is thin as fuck on Doge chain. No way to enter on chain with yeah. So I don't have much interest in 200% on Ethereum USDC. The risk of the bridge, the risk of the tokenized representation or whatever bridge implementation they have, just the risk of whatever protocol has implemented, the LP position, I have no interest in that kind of exposure. Um, if you had that kind of LP somewhere on mainnet, maybe on one of the predominant AMMs, that'd be interesting. You know what did catch my eye? Elastic swap. I showed this to you yesterday, Dan. You saw it on the forum. Interesting. Mainnet. Um, pool or stake because it's ample USDC 1800%. Because we've entertained Ampleforth before, and obviously it contracts significantly to the downside. But look at the TV. I mean, I have no idea. I don't. I saw big numbers, and I'm trying to digest the significance of it. So Ampleforth has always been a fascinating token, and it still is. It's not about. It was a rebasing token, so obviously you said yesterday, is it still interesting? But Ampleforth still is because it works. If you look at Ample, it's quite a fascinating asset. And it happens to be below $1. So you guys know what that means when it's below $1? That means it rebases up and decreasing supply, it contracts supply. So that's appreciative on the asset. So it's supposed to be up and down. It's supposed to do exactly what it's doing in this chart, which is just fascinating because it's very predictable. If you buy it at 2, it's going to come down, which means you, you're going to get an increasing in supply. It's rebasing up, and there's increase in supply. So you're at 2. So you buy it here, it goes to 2, and now it's doubling in supply. So people are liquidating, taking profits, and it drives it down. And then it contracts, and it drives it up. So Ampleforth always was interesting. Um, Joe, what do you think of solidly priced activity? Well, obviously people are FOMOing and they're thinking along those lines. Fortunately, I don't have much to do other than to click a couple of buttons. I just have to burn this stuff. And that's cool. I'm gonna wrap it up. I gotta close my eyes for a couple of minutes. Notice the yawn. Um, enter one thing, exiting another. Well said, Kazin. Well said. Well said. Yeah, even cash. Cash is just merely a position. TradFi is expecting retest of June lows Q3. We'll see what happens. Where's ES? We'll see. Whatever you all should expect the unexpected. Because, man, this shit is crazy. From a macro perspective, from a micro and equities market, and a micro in the crypto space, these markets are wild. I mean, I haven't been in the space more than a decade, but you know, even for me, it's wild. But I'm sure even the old school boys that know equities markets from 10, 20, 30, 40 years ago, they must think what's going on is pretty wild. Multi-chain is the main bridge. Risk is probably the chain itself and the bridge from Doge. Yeah, you know, in the end, we all subjectively engage with markets, and even I entertain X. There's nothing wrong with these types of things. But folks will have to do what they want to do, and I have absolutely no interest in going out on risk curves. I want plain, vanilla, boring Ethereum mainnet. The most I'll go is to Arbitrum, Optimism, Phantom, Avalanche, Polygon. That's about it. I don't even dive into Solana. I don't. I don't want to. And that's my deal. What is the token given on Elastic yield? 1800%. 1800%, Dan. Only interesting thing about Dogechain, in my opinion, is that Sam added Frax liquidity. Okay, cool. Great. So guess what? Dogechain's a red herring. Go get him, Frax. Go get him, Sam. That's the deal. All right. I hope this helps, guys. Obviously, this is a wild market, and you have to maintain rationality at all times to protect capital and ultimately, hopefully, survive to the next bullish market conditions. Thank you all for joining. Friday, September 2nd, 12:23 m. 12:23 p.m. As always, tell everyone to subscribe because we can only help people if they subscribe. After party on Discord for the most rational community in the entire crypto space. Appreciate all of you guys in there. You know, more and more as time goes on, particularly because you guys are so freaking rational. It's really cool. There's very few assets that folks talk about on Discord. It's a very concentrated set of assets, really along the principles that we talk about: federation, cash flow, enterprise, and it's very little speculation and significantly going out on the risk curve. So it's really good conversations, guys. I really appreciate you all. It's Friday. There's nothing on Monday, holiday weekend. I wish you all a good, safe, happy, healthy weekend, and I will see you guys next week.